So I'm going to tell you all about banking as a service. We're also known as a B2B wholesale mobile bank. And what exactly is that? Because it's really a new category. And following kind of Joachim's lead, don't mind my English American accent. So clearly, So one of the things that's interesting in this category, it's literally a $30 trillion category, right? It's huge, right? Anywhere money is moving is this category. And of this right now, 160 billion is actually mobile related, which is still a tiny chunk, right? So what's interesting is when people like Apple enter in this category, or optically appear to enter into this category, it's really kind of a tide that's actually rising all boats in this mobile area. And for us, it's great news, and it's really a great development. And so what's also interesting to note here, too, is you'll take a look, the amount of money that's actually moving through on this upper right that's actually coming in through non-banks is still a pretty small amount, right? And by law, at least, you need to be a bank in order to actually hold money, right? And so clearly, when you are a bank, you're able to move it in the most efficient manner possible. And when you're a non-bank, you have to partner with a bank in order to actually move it legally. There's other ways to do it, but it ends up being much harder. And so typically, when people talk about disruption, it ends up being trying to bypass the whole regulatory regime, which ends up usually being the easiest way to do it. But when it comes to money, it ends up being one of those areas where you can get into a lot of trouble and you can even go to jail, right? And so, for us, for ND Bank Group, we're very much focused on innovating within the regulatory regime and providing innovation inside as a bank itself, right? And so we'll go into kind of more details around that. So, who exactly are we in terms of our leadership? Ex-Citibank executives, as well as myself. I used to be a wireless guy. I used to work at Verizon Wireless. And so, and it's relevant because you need to be a banker in order to own a bank. And so for Citibank, this is one of those areas where they looked at exploring, a B2B wholesale mobile bank long, long ago, like during the John Reed days. And it's one of those things where we can always talk about how if you want to innovate, you need to be willing to eat your own young, because if you don't, someone else will. But that sounds cool and to hear and learn in business school. But if you're in the case of Citibank, if you're a big bank and you're the largest and you're the incumbent and you're also disrupting yourself, and on one hand you're innovating and coming up with new things, and it's at the expense of the other side of the business, and it's all tied back to the same stock price. Guess what? It doesn't get beyond a pet project before it gets killed, right? Because it's going to actually destroy shareholder value when this cool new thing is actually disrupting at the expense of the other side of the body. And so, Bob Williamsted's our chairman, and it was very important for him to be the chairman for our bank, because what we realized early on is we need to be a small bank in order to help disrupt, because you want to be in a situation where you have nothing to lose and a lot to gain, right? If you have a lot to lose, you're not going to be as motivated and as hungry and as aggressive. And 100 million in the banking world is a small bank, right? So we're a small rounding error compared to the typical large national banks. And so for myself, clearly, when I used to work at Verizon, I was leading new technologies, new business ventures, new stuff, where I would evaluate cool new things to figure out what we could actually commercialize and grow to complete scale, right? And so one of the areas that we evaluated was mobile financial services, and we viewed that for Verizon, our revenue was $100 billion a year plus. So it needs to be at least $1 billion opportunity in order for it to even move the needle and be interesting. And so that's actually how I kind of evolved from being a wireless guy now into kind of a mobile banking guy. So what are we at the intersection of here? And I think really on the left-hand side, all the aspects that are associated with banking, we do it. We follow it. We do all the rules. We play in every dimension possible, but we'll do it in a more modern way, right? So in the U.S., there's rules around know your customer, KYC, right? And so typical banks, when you want to open up a bank account, it requires that someone actually show up in person, show their identity, go through some painful paper procedure, fill out all this stuff, and then your account gets created. But there's actually nowhere in banking law that says you need to physically show up, and nowhere does it say you need to do all this stuff. But basically, the reason that stuff is done is that's the way it was done 30 years ago, and no one's been actually super motivated to change it because that requires a lot of extra work, right? So for us, a much more modern way, I mean, think about it, when you actually got your driver's license like 20, 30 years ago, it was a piece of paper and it just had your name and address on it. Today, you look at a driver's license and it's got like 20, 30 different forms of identity and verification, holographic images, QR codes, triangulation up the wazoo. And by the way, the DMV, the Division of Motor Vehicles, also has APIs that you can actually access to validate in real time. So why doesn't a bank actually leverage any of that? Well, for us, we do. So we'll access that information in real time, take a picture off the driver's license, provide real-time verification, triangulate with your Social Security and different databases, and do that in the most modern and most performant way. And we'll do that in a lower cost manner, right? And so on the right-hand side, we're very much focused on innovating in the payments world. No shortage of innovation occurring in the payments world, beyond PayPal, Stripe, all other things that are occurring. We're able to do that here, but as a bank, we're able to move money in the most cost-effective manner in and out, whether it's coming in through credit, debit, or going through across their Fed wire. And we end up being at this intersection here where we then provide the APIs that allow people to do this as well, leveraging their brand, and we end up powering it behind the scenes. So when was the last time any of you went to a physical bank branch? I think you, Joaquin, you probably went there to get those $20, $5,000, whatever, $20 bills, right? But for us, it's like one of those things where the millennials and even our generation, we don't go to the bank branch, right? I mean, you either get your money in as EFT, you have ATM, you're using your mobile, and you're doing digital, right? Older generations go to the classic bank and have a banking relationship with the branch manager. If I go to my bank, they don't know who I am at all, right? I mean, because I go there when I open an account and I go there when I close an account. I don't go there anywhere in between. And that's the majority of the world these days in the developed markets. So we view the smartphone as literally our channel. This is our branch. And so with the smartphone being our branch, the app is literally the brand. And at that point, fill in the blank brand. And I think a lot of our focus initially is big brands, because big brands end up being brands that we trust and are willing to do more with than we're currently doing. And so at that point, in the scenario of Verizon has 100 million subscribers. Even if just 5% say, yeah, I'm willing to bank with Verizon, that's 5 million new bank accounts that are Verizon branded. For a bank to get 5 million new subscribers, that's a lot of work. And so for us, if you're a small rounding error off of a large user base, you can actually grow a user base very, very quickly. And I think in that scenario, I'll provide a little more insight around what that means, because we're not advocating that someone actually goes around saying, hey, I'm a Verizon bank or I'm a Google bank. What ends up happening is it ends up being more positioned like a rewards program. It ends up being a loyalty program. It ends up being a feature of someone else's service. So imagine payments being a feature of Amazon Prime. Right? In that scenario, you look at Prime as a shopping club, but now payments could be a feature of that. Right? And so in that scenario, and one of the research elements that we did a while ago was, if you're going to go into kind of mobile banking, make sure you don't call it a bank, because there's a lot of luggage associated with the word bank. And so even though there's a lot of pros, there's also some cons. Right? And so for us kind of being able to be in a position where we're enabling non-banks, they don't actually have a lot of the luggage. And we end up kind of taking care of a lot of the burdens. By the way, anyone want to venture to guess what a classic big bank views the cost to open, maintain, and manage an account per user per year? Anyone want to guess? $340 a year. Right? So we live in this day and age with Amazon Web Services, where we all know as fellow semi-techies here, what it really costs to rent space on a server farm and manage it and maintain it. But you know how they get this $340 a year number? They literally add up all the costs of the brick and mortar branches, and they add up all the costs of their IT, and they divide it by account. And that's the funny math that they actually end up getting to, the $340, which is why in the United States, there's actually 40 million people that don't even have a bank account, because the banks reject them and refuse to service them, because in their minds, they're actually not going to make money. They're never going to make back $340 a year, so they're not even worth serving at all. Right? So in the US, we have 40 million people that fall into this underbanked and underserved category. For us, that is a segment of our business. It's not the only segment, but for us, because our costs, we don't have thousands and thousands of brick and mortar branches, our cost ends up being much, much lower. So we're going to say yes to a whole lot more people than regular banks would as well. So let's kind of dive a little into kind of a few more of the aspects of kind of like what makes our business different, right? So in the classic kind of banking model, a lot of brick and mortar, high costs. And by the way, while we're willing to leverage brick and mortar from our partners, we're not standing up a brick and mortar branch for the sole purpose of bringing people's foot traffic in, right? So for us, our model is mobile first. We're low cost. We end up being much, much cheaper in a disruptive manner as well. On the settlement front, typically it'll be multi-party schemes, but also 1 to 7 days in terms of overall settlement, right? And so on that front, some countries have real-time settlement requirements. The U.S. does not have it yet, but for us, we end up being real-time, right? So we'll actually settle in real-time seconds. And I think what ends up being important on that front is another reason why banks typically will reject people is, and I'm sure some of you have had this happen when you're younger. You might check your ATM machine and see there's cash, take money out, and then later on, the next day, you get insufficient funds fees because at night, some other check or bill settled, and then the bank at night used their mainframe to settle at midnight, and they realized that more money went out than actually was there. And by the way, guess who gets punished? The end user, the end customer, right? And so in our scenario, because we're settling in seconds, there's no issue about how much money is actually there because we know exactly what's there. And as soon as that gets updated, it gets changed. And so you're only when you go to the ATM machine and whatever money you see there is really there because we've already reconciled completely. In terms of our costs, and this probably is like more along the retail side where in general the transaction fees range 2 to 5%. For us, we end up being less than 1%, right? So, and I think in terms of like, if you look at someone like an Amazon, anyone want to guess what interchange is for Amazon? This is public information. Everyone know what interchange is? It's the 150 to 250 basis points that a merchant typically pays to the credit card company, right? So if you are buying something at Amazon and you spend $100, the merchant's actually only keeping $98 because $2 of that went out to pay the banks. Well, in that case, Amazon has like $1 billion a year in interchange. That's a lot of money, right? And so anything that can be done to reduce the cost of movement and then the cost of fees in general goes straight to the bottom line. So for us on the development integration front, when was the last time you went to a open bank, right? And I mean, not by like a physically open one, but like one with open APIs that allow you to leverage it and use it and develop against it, right? So for us, we are very much kind of open architecture where we provide the APIs. They're free to access, but obviously there's charges and usages associated with the utilization of it. But we end up being kind of an open book in terms of how we operate, right? On the branding front, if you try to partner with a bank, a big bank, it's their brand and it's their customer, and they're going to focus on that completely. Whereas for us, in contrast, we're a white label bank, which means we're very humble. We're behind the scenes, right? So we'll be that 3-point font in the back of the card, but we're not trying to kind of grandstand and be at the front of everything, right? I mean, imagine if you partner with Apple. Apple doesn't want your brand to be competing with their brand. They want you to be somewhere behind the scenes, and we're totally fine because that's our whole business model. And so for us, in exchange for leveraging their brand, our business model is very simple. It's revenue share, right? So we share revenue around the money that's being made from the customer, but we do it in a manner that provides like very fundamental alignment with incentives. So how do we end up doing this? I think really, in terms of our architecture behind the scenes, when you look at in the U.S. at least, there's like 6,000 to 7,000 banks, right? And there's about a dozen big national banks, the Citibanks, the Wells Fargos, the Chases. And when you look at the back end of a large national bank, it really looks like that. I mean, it's stovepipey, it's stodgy, it's literally a series of M&A acquisitions from the past few decades, right? And so what that means is even though an acquisition will occur, they put the new logo to show the acquired asset, but behind the scenes, it's really a hodgepodge of a lot of different things. And that means, as a result, it's very difficult to kind of integrate new things because it is kind of a lot of stuff behind the scenes. And so because of that, no one really wants to change it or rock it. And when you do, it ends up costing a lot of money. Whereas in contrast, for us, because we're a mobile-first bank, services-oriented architecture built in the 21st century, our back end ends up being the same as the back end that M-Pesa uses. Literally, it's very modern, it's very clean, and much lower costs, and it's also highly performant, right? And so these are costs that don't end up translating to much bigger margins for us. It just means that we actually pass the savings onto the customer, but then we also have enough to share with our partner, right? And so that ends up being pretty integral in terms of how we operate as well. So when we then kind of look at the overall architecture in terms of behind the scenes, we really look at this kind of like from a three-layered manner, right? So at the most foundational level, it's the APIs that we use to kind of run our business, right? And so these APIs around know your customer, around any money laundering, opening an account, checking the balance, moving money in and out. Those APIs, we call it NDNA, and by the way, I didn't elaborate what ND stands for, but in Latin, it's Numoris Doloris, which is basically graceful movement of money, right? And so NDNA is the name of our banking as a service platform at the most foundational layer. So if we're dealing with a sophisticated client, we'll provide them access to our APIs, and they can kind of program away and develop whatever they need, however they need. And if it's a medium capacity kind of customer, then we'll actually intersect at their middleware. And then we also can do the end user layer at the top, right? And so for a less sophisticated client, we'll deliver the whole thing, top to bottom, right? But for more sophisticated ones, we'll just feed them the APIs and let them kind of do whatever they need. So if we want to kind of then like dive into kind of the different focus areas that we have, digital banking ends up being kind of the core kind of underpinning, and this is like one of those areas where it ends up being pretty straightforward. In terms of kind of the way we operate, we are primarily focused on like transaction fees as opposed to classic lending. I think it's very easy to loan a lot of money and never get it back. Right? So it's like the whole banking crisis ended up really occurring from giving away too much principal on the hope of getting some interest. And so that's one of those areas where it's really easy to lose a lot of money in the world of lending. And so for us, we're not viewing lending as kind of like our first order priority. We will do it, but we only do that when we have an advantage, right? And so in the case of wireless carriers, many of them are looking into kind of more creative device financing capabilities, right? And so if someone now says, hey, you can buy your phone with no money down, because right now everyone's already familiar, well, in the US at least, we've got device subsidies, so it's already device subsidized, but it ends up costing $199 or $299 out of pocket. But if you're actually in a market like here, where there's no device subsidy at all, in the US, that would be a prepaid category. Now, a carrier can basically divide it by 24. Where if it's $600 divided by 24, they could provide that, but they haven't been able to get any interest, right? And because they're not a bank, right? And so in that scenario, if we have some extra insight, and that insight could be, well, Mr. or Mrs. Customer, if you're going to now get a device from us and we're going to finance it for you, we, the carrier, will need to be your banking relationship, right? So that suddenly now provides extra insight whereby if I see your monthly paycheck getting deposited into that carrier-branded bank account, that's just reduced my risk meaningfully because you're now putting all your money in there, right? And so it ends up being an example where lending does make sense, but for now we're much more focused on kind of like transaction fees. So we do also view this, and whether we're dealing with someone like a Google or an Apple or an Amazon or a wireless carrier, we view ourselves as an enabler, a new tool in their business model, and a new tool in their business chest, right? So if you think about Google, obviously they're primarily search. They went into Gmail to provide you the search. They're providing you free email, but they are getting some extra information from what's happening on the email front. On this front, you can imagine kind of, and they wouldn't call it, they already have Google Wallet, but it's like GBank or whatever other capabilities whereby in exchange for access to insight, they would provide and absorb a lot of those costs, right? And so part of the business here ends up being the people that we're working with already have a core business model that is successful, and now we're looking at enabling them to go to another dimension where they can kind of improve their differentiation and add payments or banking as a feature of their existing business. And so in many ways, you can actually look at this as we're, in many ways, enabling a new wave of competition in the consumer banking world. So and another element that ends up being pretty integral into kind of like how we operate is rewards, right? So we all know about loyalty, and I'm sure many of you are collecting avid fans of frequent flyer miles, right? So rewards end up driving and changing a lot of people's behaviors. And so right now, we already, I'm sure many of you also have a Starbucks rewards account, right? So you load some money into your, to feed your caffeine habit, and you don't mind because you know that, hey, every 12 stars, you're going to get a drink. That drink is on them, right? And so that little thing ends up steering you to go to Starbucks a little more frequently than you would have otherwise. And so similarly, for us, if what we're offering ends up being kind of money rewards type program, and whether it's part of a retailer or whether it's part of a wireless carrier, you're now going to think about moving your money into this carrier branded account or this retailer account, because you're going to get double or triple rewards. You might not move your whole paycheck there overnight, but you're willing to move a little, right? And so let's just take the Amazon example. Let's say instead of paying $99 a year for Prime, now you can pay $50 a year. But in exchange, you need to put a $500 a month deposit into your Amazon Prime account. So in that scenario, you've now set aside some money for your Amazon spending, right? And so most people aren't afraid to do that, because if they already know they're going to be spending there, that's actually okay, and you're getting rewarded because essentially the money has been set aside, and it's not trapped, right? Because for us, we're an open account. We're not a closed account, right? So typically a closed private label account ends up being a situation where you put money in and you can only use it at that one vendor, right? For us, we're literally an open account, which means the money goes in, and it might be Amazon branded, it might be Target branded, it might be Costco branded, but it's accepted in the world anywhere, right? Because it's an open account. And in that scenario, if it's a retail, we'll actually provide revenue share on the interchange as well, right? And oh, by the way, in that scenario too, if you're a retailer and you're now spending, and if you're in Amazon, you're spending in Amazon, interchange just went down a lot too. And I'll go through a few more examples of that. And clearly, for us, we end up being FDIC insured in terms of kind of the overall banking aspects that apply. And then, for us, clearly innovative is a broad word, but for us, we are very much focused around delivering delightful experiences to the end user. When was the last time you had a delightful banking experience? I mean, because usually you get pricked by a fee here, a fee there, a fee there. And over time, it's just painful, right? And so, and that's kind of why banks historically have been, charging whatever they can charge, and that hasn't scored a lot of points with consumers. And so for us, like, we might be able to charge a lot higher, but we're not going to. And so we'll actually charge a lot lower because we can, and then it'll be through the friendly consumer brands that you're already familiar with. So when we then look at kind of our overall, a couple of our customer segments, we do view wireless carriers as kind of like a whole category in and of itself. Tier 1, Tier 2, Tier 3. And so in the US at least, it's, the Tier 1s end up being the big national carriers, and then there's like smaller national carriers, Tier 2, and Tier 3 end up being the regional carriers, the smaller carriers. And so in any market where there's like 5 competitors in every major city, it ends up being very competitive, right? And so for us, we're very much focused on helping to reduce stickiness, increase stickiness, reduce churn, right? And so we're looking at conservative 10% uplift in ARPU right? So if you're familiar with kind of the wireless terminology, that's a 10% boost in revenue in terms of like a new revenue generating source for our partner clients. But then if we can reduce the churn and reduce and increase the stickiness, and it costs $400, $600 to kind of get a new customer, that's even more value added, right? So the revenue generating is important, but then it also needs to kind of deal with the other elements that are core to the business. But also candidly, even though talking about reducing churn and increasing stickiness sounds great, it's not quantitatively rigorous, because it's hard for someone to go, well, how much churn did you actually do? And it doesn't happen overnight, right? So on the consumer technology front, I think they did some sort of study a while ago. If Apple were to create like an iBank, like a third of all Apple loyalists would bank with Apple, because people love Apple that much. They're willing to they trust it so much that they will go there just because it's an Apple thing, right? And so for us, the consumer technology area, whether it's Apple, whether it's Samsung, these are already brands that have big budgets, and people are comfortable with them, and they already trust them, right? The newer generations, we have trust for these brands because they have billion-dollar marketing budgets, and we like their products, and we use their products every day. Retailers end up being another big category for us, and so on that front, the examples I've already given, whether it's Amazon, whether it's Costco, whether they all spend money on interchange, and this ends up being a new tool in their tool chest, whereby now they can accept deposits, and essentially it becomes a dedicated spending account, but it's still a flexible spending account, because now when they spend money in that retailer, instead of paying 250 or 150 basis points, it goes down to like 50, right? And that's a pretty meaningful reduction in terms of the cost of a transaction. On the social front, really what we're looking at there, I don't know, how many of you use Snapchat? Anyone? How about Wicker? How about Kik? Yeah, how about Facebook Messenger? Facebook Messenger? Oh, there we go. Yeah. So on the Messenger front, I think within Facebook itself, they've really been evolving. Clearly, like a fourth of the planet's already on them. And so, we really kind of view these dedicated pathways in terms of P2P as new ways to kind of facilitate payment. If you're sending someone a new flavored SMS, literally, it's just one extra step to actually have it be money, right? And so these ecosystems whereby there's tens of millions and growing rapidly in terms of interconnecting end up being natural points to kind of extend money off of into as well. And then we also look at servicing and enabling banks, right? So at least in the U.S., those 6,000 banks that I described, the top 10, top 12 that have kind of the more stodgier infrastructure. The other 6,000 banks in the US, they don't even have an IT department. They're buying products from companies like FIS and Fiserv, and so they end up having their own issues in terms of what they're able to do. So for us, kind of this mobile, modern architecture that we have in terms of our technology, we can also enable the smaller banks to actually be more up to date, right? And I think it remains to be seen what's going to happen with classic brick and mortar on the banking front. But I'd say the outlook doesn't look great, right? When the branch is like 80% underutilized, the math is not very promising, right? And then the people that used to come in all the time are dying. It's kind of like what's going to come in and replace them. So, and then this last category is around kind of the B2C apps, and again, I can talk a little more about what that. I'll go into a couple of examples around some of those possibilities, because you might hear this and wonder, well, how does this actually apply to me every day? And I'll talk with Maribel about what that looks like. And then the long tail, and hence the banking as a service. These are a couple of the use cases that we focused and highlighted and targeted. The long tail is why we had the banking as a service platform. We don't have to come up with all the possible scenarios and use cases where this applies, right? If you have a use case that you need that involves moving money, well, our APIs are there so that you can do them on your own. You don't need to involve us to actually make it happen. And so with that, that's all I got.
Great presentation. Really interesting banking as a service. We've got an understanding of that now. Quickly, in the interest of time, any other B2C examples, other market opportunities that you're thinking of?
Absolutely. So, two apps that we're kind of working on. One is called Tip Jar, right? So, the Tip Jar app is literally a scenario whereby I'm sure you've all had this happen. You're going to a 4-star, 5-star hotel and you don't have any cash. And so it's like one of the situations where it's like you see the valet and you're like, you've only got big bills or nothing, and you don't want to stiff the guy because you're at a nice hotel, you can afford it. But what ends up happening is you tell the valet, sorry, I don't have any cash, but if you install Tip Jar, on my way out, I can send you a digital electronic tip, right? So what ends up happening is the valet ends up installing Tip Jar, and so they end up taking a picture of their driver's license, they put in their social security number, they're effectively opening a Tip Jar receiver account. And then on the way out, I ask the valet, what's your 4-digit code, right? And so they'll give me the 4-digit code, and then I can send them a tip. Because you, the tipper, can just like take a $10 charge or $20 charge off your Amex corporate card. Because, oh, by the way, when was the last time you ever expensed a tip, right? It slips through the cracks, right? So in that case, basically you're moving money in there to kind of facilitate tipping. And now money has just moved. Real money is sent. That valet guy is actually going to get a debit card in the mail. And it's real money, right? And so it's one of those situations where, so that's one. And the other one is another app called Food Truck, right? So Food Truck basically says, it's kind of like Uber and Square intersecting, right? And so we've all had this happen where you'd open up the app and it actually would tell you all the food trucks that are around you. And then you can kind of order and pick the food menu items, but you still have to walk to the food truck, right, to get the food, right? So what ends up happening is we'll use Bluetooth, BLE, and so as you start approaching the food truck, when it reaches within the Bluetooth 30-foot range, the order gets transmitted into the food truck, so the food truck person will start preparing the food. The order has been received and paid for, and when you arrive at the truck, you're actually waiting there to pick up the fresh food, right? You're not going there to order the food, right? And so those scenarios end up being kind of, and that's just two examples, but at the end of the day, there's probably like thousands or hundreds of examples, and so the whole point of our banking as a service platform is to let the mobile developer ecosystem build whatever is needed, because we don't have a monopoly on all the best ideas, and our platform allows for others to leverage it to its fullest.
Awesome. Thank you, Humphrey.
All right, cool.